Imagine this. You're not in a boring office. You're not in a classroom. You are inside a financial drama series. There's money moving, numbers changing, people arguing over receipts, and somewhere in the corner, an accountant calmly sipping coffee like they know every secret of the universe. That, my friend, is accounting. But here's the twist. Accounting isn't just math, it's storytelling. It tells the story of your business in numbers. Over the next 10 minutes, I'm going to break down financial accounting in a way that's actually entertaining, actually makes sense, and won't put you to sleep. Buckle up. What is accounting? Think of accounting like a giant financial tree. At the top, you've got accounting. Then the branches split into different types: financial accounting, managerial accounting, tax accounting, auditing, bookkeeping. But when most people say accounting, they usually mean financial accounting. So what is financial accounting? Simple version, it's how businesses track, organize, and report their money so the world knows what's really going on. More dramatic version, it's the system that separates real businesses from chaotic cash-burning machines. Financial accounting does four main things: identifies transactions, records them, summarizes them, and reports them in financial statements. That's it. But behind those four steps is an entire world of logic. Our fun business example. Let's make this fun. Meet Galactic Coffee Co. Caffeine, cosmic style. A trendy coffee shop that sells cosmic lattes, meteor mochas, and black hole espresso. In March, Galactic Coffee runs a crazy promotion. Buy a 12-month VIP coffee pass and get free drinks all year. People go wild. Space theme, viral TikTok. The line wraps around the block. By the end of March, they collect $60,000 in cash from customers buying annual passes that start on April 1st. So what happens first in accounting? You identify the transaction. Galactic Coffee received $60,000 in cash. Customers paid in advance for future coffee. Boom! Step 1 complete. Journal entries. Now we move to step 2, recording the transaction. In accounting, this happens in something called a journal entry. A journal entry is basically a financial diary. It includes a date, a description, the accounts affected, debits, and credits. For Galactic Coffee, the entry looks like this in concept: debit cash, $60,000, credit subscription revenue, $60,000. Why two sides? Because of double entry accounting. Which brings us to the most important idea in all of accounting: the accounting equation. Accounting is built on one simple idea: what you own equals what you owe. In accounting language, assets equal liabilities plus equity. Let's break that down. Assets are stuff the business owns: cash, machines, equipment, coffee beans. Liabilities are stuff the business owes to others: loans, unpaid bills, obligations. Equity is what the owners are entitled to, basically what's left after paying debts. This equation is the backbone of accounting. Every single transaction must keep this equation balanced. That's why we use debits and credits. They represent the two sides of every transaction. For Galactic Coffee, cash increases, asset; revenue increases, equity. Still balanced. Perfect harmony. Accountants love this stuff. T accounts. Now, accountants visualize transactions using something called T accounts. Imagine two big letter T's. On the left, cash. On the right, subscription revenue. Left side equals debits. Right side equals credits. So we add $60,000 to the left of cash. Add $60,000 to the right of revenue. Simple, clean, organized. But here's where things get interesting. Cash versus accrual accounting. Right now, Galactic Coffee has recorded the full $60,000 as revenue in March. But here's the problem. They haven't actually earned all that money yet. They got paid in advance. They still owe customers 12 months of coffee.
This is where accrual accounting comes in. Under accrual accounting, you record revenue when you earn it, not when you receive cash. By December 31st, Galactic Coffee has only earned 9 months of that coffee money. That means 3 months, $15,000, hasn't been earned yet. So we make an adjusting entry. Debit revenue, $15,000. Credit deferred revenue, a liability, $15,000. Now the books show the truth. You have cash, but you still owe coffee to customers. Accounting is honesty in numbers. Financial statements. Now we build the 3 big reports. 1. Balance sheet. Shows what the business owns and owes at a single point in time. 2. Income statement. Shows how much profit the business made over the year. 3. Cash flow statement. Shows how cash actually moved in and out of the business. These are the reports investors, banks, and governments look at. This is the language of business. Closing the books. At the end of the year, accountants make closing entries to reset revenue and expense accounts. This prepares the business for a fresh start next year. And just like that, you've completed the accounting cycle. So, what is financial accounting? It's the system that turns chaos into clarity, money into meaning, and businesses into structured machines. If you made it this far, you're already ahead of 90% of people who run businesses without understanding their own numbers. If you want more videos like this, fun, clear, and actually useful, like this video, subscribe for more, and drop accounting drama in the comments if you stayed till the end.